Hello everybody, welcome to Trader Merlin Show. It is your Monday edition, kicking things off with a makeup episode for Trader Merlin. Today we're going to have John O'Donnell on the program, because last Thursday we didn't get him on, but today we will have John on the program. We're going to talk about macroeconomics today, keep it kind of at a higher level. Of course, there's a lot of stuff that's going on in our market right now, significantly impacted and impacting those macroeconomic numbers. So thought that'd be kind of fun today. If you have questions, feel free to type them on into our chat on our YouTube channel. If you are new, then go ahead and click that little subscribe button there so you know when these videos come out. And of course, I have all kinds of great content coming out on a regular basis. Hello, Kevin and Brendan, Terry, Batista, Ruben. Good to have you with us. Brendan as well. I see Not Bad Whiskey. I got to ask Not Bad Whiskey, what's your favorite whiskey there, buddy? And Tomasina, good to have you guys with us, and I'm sure more will be joining us. Hello, Gayer. For those that were awake at midnight last night, boy, I tell you what, I looked at this market and I thought, holy crap, it is going to be a huge down day. We were down about 3.8% on the S&P, and I was thinking, man, did we go lock limit down? I didn't really see anything major out there that would have caused it, but the market just kept drifting and drifting, bottoming out, right around that, very close to the 2200, right in the 2970 or 2927 was a low, 2923 was a low on that one, and boy, all of a sudden we had a huge rally. At the end of the day, we look at the S&P up 1.38%, and you're thinking, well, that's a great day. It's nothing compared to the overall move off those lows. It's almost a 5% move from those lows, so one hell of a day. Yes, Oliver, thank you, and thumbs up are always appreciated as well, if you like the content. If you don't like the content or have suggestions or just hate me, then you can email me at tradermerlin@gmail.com and let me know what's wrong, and hopefully I can fix it. All right, let's go to your market update, and I'll show you what on earth is happening out there in our financial markets. I'll start things off at the bottom. We'll work our way up from gold. Obviously, we had a huge risk-on type of day today. We're real high volume as well on the overall market, so money pouring back in. Gold, of course, suffering a little bit here, but not much. Only down 0.32%. You can see 1,731 is where gold finished at today. Moving on to Bitcoin, which had a little bit of about face here recently. It was down pretty good, and all of a sudden reared its ugly head, up 0.53%. You got a $9,515 print on Bitcoin, but as you can see, for really the past month, it hasn't done too much. Yes, it's bounced in a 1,000-point range, but still not too much. Oh, all right. Let's keep on moving up the list. S&P 500, as I just mentioned, 1.38% move to 3,065. For those of you who are trading in the futures markets right now, you might want to take a peek at that 5-minute. I know Bob Dunn's going to say, "What in the hell are you doing looking at a 5-minute beer?" Well, we can look at this 5-minute time frame. Let me show you that 5-minute chart here just so you can see how wild it was. And we are actually sitting right now at a double top formation intraday. Judging by the momentum, though, I'm pretty sure this will probably break to the upside. It just feels way too strong. People just buying almost every single dip. Right now, you are at a double top formation on the ES, smack dab into the highs of the day at 30.65. All right, back to the daily, and I'll go up a couple more here. We got the NASDAQ 100, 1.74%, still a ways off from its highs we achieved last week, but all in all, not too bad, 9,799. Crude oil also having a nice day, back on its knees, if you will, up 2.23% to 37.07, and that is still, I thought we might go a little bit lower down this on crude oil just because of its run, but hey, if it can form a base here and start to rally up, then that gap might be closed, and that gap goes all the way back into March 6th, and that would bring us close to that $47 mark on crude oil. All right, final one. It has been the most beaten up for 3 trading sessions, and all of a sudden today, it has its day of redemption. 2.95% to the upside for the Russell 2000, finishing the day at 1419. Hopefully, for those of you who are short-term day trading, you really got out of your short positions, because this thing did an about face and just kept on rallying here, as you can see on this 5-minute time frame. Just a beautiful move for the Russell 2000, NASDAQ, and the S&P. All right, that is our opening segment. Tried to read through those rather quickly. Of course, as you guys can see, I changed the artwork here a little bit. I figured I have some nice graffiti art in my house that I took pictures of when I was in Italy, and I got a great little protest one on this side over here. I thought that's kind of appropriate for our times. All right, let's just move on to the show. Get on going with it. We're going to have John O'Donnell on the program today. And of course, for those of you who might not know, we affectionately call him the ambassador of opportunity because he points out things in the market which some of us might not be looking at. Of course, we are talking about none other than John O'Donnell. John, how you doing today?
I'm great, Merlin. How are you doing?
Good. I'm glad to finally have you on this one. Well, I'm not finally. We had you on once before, but good to have you back on, my friend.
Well, I'm glad to see you plugging along with the Trade on Merlin show, and congratulations. Your audience continues to build, and more power to you, brother. Keep it up.
Yeah, it's fun. Hey, you know, when you do what you love, it's not work anymore, and I definitely like what I'm doing. Yeah, see, I'm already getting. See, this is what I love about my audience. I'm getting complaints that my artwork isn't straight. Let me see if I can fix that. I think you're talking about this one right here, Dave. Right there. That better? I think we got a little dab over here. Okay, artwork straight. Fine. My feng shui is all better. John, tell me a little bit about what you've been doing. I haven't seen too much of you. Of course, with the office shut down and all that, I miss you around the office. What have you been up to?
Well, I've been first of all trying to stay safe. I've been cautious about at my age, I'm in that key category that is highly susceptible to having the biggest challenges with a virus. So I've been kind of laying low from that perspective. But I've taken this time, away from Online Trading Academy to focus on the rubber ducky trade formula by Tim Blossert. And Tim have been coaching me, and I hadn't had much exposure to options. Probably one of the biggest mistakes I made working in Online Trading Academy all those years was not taking the school up on learning various option strategies, but especially I found a liking to the rubber ducky. I'm not going to sit here and tell you I'm an expert in it, but I've been making fantastic progress, and it's beautiful. And I would encourage your listeners to take a look into it.
Yeah.
I'm cautiously optimistic that Online Trading Academy will be having some education around the rubber ducky strategy that you should take a hard look at it, especially if you're interested in income.
Yeah, we actually had him. We had him on the program. Maybe 2 weeks ago, where he talked about the basics of it, and I'll probably have him on here another week or two to continue on with that. It was really just looking at. We did it from for those who want to look at it on Trade and Merlin. I think we titled that one "Day Trading Options" was the title of it. Maybe the next one we'll just call the flat out rubber ducky. This is just a specific strategy that Tim uses, and one of the beauties of doing this show, and as a viewer, you get to see all these different traders and maybe a little bit about their personal styles. And what Tim does is different than what a Steve Moses is going to do, or Brandon Wendell. We all do things slightly differently, and we find things we resonate with. And I think it was interesting, John, that you pointed out that you really like that strategy, that rubber ducky strategy. So I'm glad you found something that resonated with you in the option space.
Yep. Well, it's very unique, but it's absolutely, it doesn't take overnight risks, and it's really income focused. So if you're interested in those particular categories, some are, some aren't, take a look at it. That's probably
absolutely
the best advice I could give anybody.
John, you for those that aren't on John's mailing list, sometimes John just loves to machine gun emails out there and charts. And he sends over a lot of great charts to me, many of which have become chart of the weeks for this program and also for John O'Donnell. I want to walk through maybe a couple of the charts you sent out. One of that I found very interesting was the CPI numbers, and there's for the first time ever on record, I believe, is the tagline behind this. We had 3 consecutive months of negative CPI numbers, which, of course, for those that don't know, CPI stands for Consumer Price Index. It's the price that you and I pay for a basket of goods and services. And normally, there should be an inflationary pressure there running about 2%. We see all of a sudden 3 consecutive months of negative, which would lead us more towards deflationary pressure. What does that signal for you, or what impact do you think that's going to have for our market?
Well, what it signals for me is that there's been a tremendous demand destruction challenge in almost all sectors. There are very few sectors that haven't been greatly impacted by demand destruction. Assuming those businesses haven't lost their capacity to produce goods and services, and what it really means from a deflation perspective is that it's telling us that prices for various goods and services, with the amount of supply capacity that we have, are going to go lower. And when you compound, and the best example of that might be the airlines. If you have an 80% decline in airline demand for those seats for a lot of reasons, people just don't want to take the risk of flying, and they're modifying their behavior using new technologies like video conferencing. And but you still have the capacity of all those planes that have been built that are on the balance sheet, probably of a leasing company, and the airlines have leased them. But you have all that capacity to move people from point A to point B. There's going to have to be adjustment in prices. It's just supply and demand over and over again. It's markets are always about price discovery through supply and demand, and you see the same thing in hotel rooms. I have a daughter-in-law that runs a Wyndham Hotel franchise up in Montana. At the peak of the pandemic, their room availability declined over 80%. People aren't getting on planes and flying to Montana, I guess. And then secondly, now it's back up to about a 40% decline. But they still have all those rooms that are available for somebody to rent. They've had to drop their pricing because all the other hotel rooms in town are compete with them for those room nights. Apparently there's a lot of freight traffic that ends up coming through where she's at. But all that traffic has gone down. So it's supply and demand, and prices must adjust. By the way, the Austrian School of Economics does not think deflation is bad at all. It means that your dollar is growing in buying power. You could buy more goods and services. But, right now, I don't need airline seats. Right now, I don't necessarily need a hotel room. I need food, shelter. I'm not too worried about clothing. By the way, that image you're putting up on the YouTube feed, that is not my pandemic uniform.
You don't wear clothes, that's why just for everybody knows, that's why we could not run John on the show today with Skype, because John's literally not wearing clothes. So I said, hey buddy, we got to have something on. So you're saving money there. It's save those costs, those expenses. In the long run, it all pans out.
But prices are going to adjust. You want to see a movie today, AMC has announced that the biggest movie theater chain out there, that they very well may just close their doors, that they don't see a great future for the exhibition of movies. Now, they may or may be right, but somebody will probably buy that, system. I don't know if it's going to go bankrupt or not, but it's going to be a damn cheap price, I can assure you of that. So there are going to be some industries that are but they're going to have the opportunity in this new pricing model through price discovery, supply and demand, and transparency in market price. I mean, I think we're all for transparency in market price.
I would agree. I mean, we certainly want transparency in market price, but when I see something like that, and it's normal for prices to be rising, I think that's just a straight up Keynesian economic philosophy, but normally we see that happening. When I look at this chart, I'll bring it up for the viewers at home again. There's two numbers here. I know we got some people listening to the podcast, so I'll give you an idea. This just goes back to 2012, so it's not a long sampling of data. In blue, you have consumer price index for all urban consumers, all activity in the U.S. city average. So that obviously took a huge dive here in 2020. I think it's very evident, went all the way down to negative 0.8. Well, normally that line oscillates back and forth above and below 0.02. So you have usually, it's fairly decent price fluctuations, but it's around 0.2%. When we strip out the most volatile components, which are food and energy, and of course, energy has been absolutely nuts lately, you get a different picture. It's a little bit more smooth. Those volatile swings aren't there, except for the one you see here on the hard red edge for 2020, where it all of a sudden spiked down. So I'm okay with the deflationary side of things, but I just I have to wonder, what's the long-term impact here? Because this is, for right now, it's different than the norm, and the norm is what we're used to. So how does this potentially impact us going forward?
Well, it means we're all going to have to be very agile. If we're producers of goods and services, we're going to have to be very, very agile in how we put our product or service out to the marketplace, where all of us have competition. I mean, I don't care who you are. and probably airline seats, and that's a little bit not of a free market because there are some exclusivities on some of those routes to the FAA. However, to hotel rooms, I don't know of any city you can't go to where there's always three or four different hotels that you can choose from of varying quality. So we're all going to have to be flexible as producers on goods and services. Other market won't clear. It won't clear. People will go into consumer drought, and it's going to impact every industry and every sector. But this is going to be the opportunity to reinvent your business model, to be agile, reinvent your business model, because as Mike Richardson brought up so frequently and elegantly, I believe now, over a year ago when we started talking on Power Trading Radio about living and adapting to the age of VUCA.
Yeah.
Volatility, uncertainty, complexity, and ambiguity. If what we haven't gone through as Online Trading Academy and others in the space isn't VUCA on squared steroids, you and I are never going to see it in our lifetime. It is outrageous. And look at what all the companies, and look at what the vendors are doing and the suppliers. Everybody's adapting their model. I mean, look at Disney. Disney's cutting back on first-run movies. They're going to, put them into their streaming service very, very quickly. So entertainment's going to be dramatically. How are we going to consume our entertainment? How's it going to be delivered? Look at healthcare services. The delivery of healthcare services, especially in an information age, the healthcare industry needed to have some VUCA to shake it up, other than we didn't need, this pandemic to cause a terrible shortage of ventilators and PPE, and that didn't work out too well. But every industry is going to have to adapt, and it's adapt or die. And if you don't, it's estimated, I saw a good analyst report today, that 25% of the restaurants are probably not going to reopen. They're especially the independents. And I think I'd like to think that's a reasonable estimate. Who knows for sure? But the companies that are well capitalized, that have strong brands, that can adapt. Well, the fast food industry adapted a long time ago. Curb service, drive-through, low pricing.
But John, we also saw something really interesting during this pandemic, which was certain stores were allowed to remain open. So, I got my Target, I got my Walmart, I got my my Home Depot, and I drive down the street, and there are companies that might sell the same products that could not be open, and they were all the mom and pop small stores. And I like, boy, if this isn't an attempt to squash small businesses, I found it astounding that I could only shop at the major nationally recognized franchises, whereas if I want to go to the small mom and pop ones, they were all shut down across the board. It was kind of bizarre to me.
Well, yeah, if they have the basic same product mix, I mean, if you have a little local mom and pop grocery store and across the street is a Target, I doubt if they have the same product mix, nor probably don't have the same pricing. But look at the balance sheets of little mom and pop. Did the mom and pop have to lay off some people? Did the mom and pop on the corner have demand destruction? And people, I mean, look at what happened to Walmart. Walmart, was getting its clock cleaned by Amazon. They adapted and pivoted very quickly and they've had just a gangbusters year. Look at the likes of Kroger and some of the supermarket chains. I've wondered for years how the little mom and pops could even compete with them. I guess it certainly wasn't necessarily on price because they don't have the volume to get price. I guess it's on convenience. I'm going to get some milk and bread, and I don't want to, get out of my pajamas. But I don't know.
Let me switch here because I want to bring up this picture. Just for anybody who listens to me on this show for a while, you realize that I'm a pretty big skeptic, and I'm very skeptical around the whole data thing. And we looked at CPI showing, for what all intents and purposes looks like deflationary pressure. We're not seeing those prices rise. We're actually seeing them fall. And I made the point that, my 12-ounce beers that I buy, all of a sudden now some of them are like 11.3. My orange juice that used to be 64 ounces for as long as I can remember is now all of a sudden 58. Here's the new one that I wanted to show everybody. I literally took this picture yesterday at Home Depot. Now remember, Apparently, the coronavirus means that we're no longer going to be able to wipe our butts, so we all had to run out there and buy toilet paper. And there's a huge run on toilet paper. I took this picture at Home Depot yesterday. I want you to notice the size of these rolls are significantly smaller than the ones that you would buy, 8 months ago. Not only are they narrower, so, let's say you had a toilet paper roll that was like 4.5 inches wide. Well, now it's 4. So they sucked off a half inch of toilet paper for however many damn sheets. And then they also made them smaller. So instead of getting, let's say, 200 squares, as Seinfeld would say, I have no square to spare. All of a sudden now I don't have 200. I've got like 150. So, I've been a skeptic on this one for a long time, John, which says that we are seeing inflation, but the metrics that they're reporting inflation on, one roll of toilet paper, has changed. It's still a roll of toilet paper, but it's lost 30% of its quantity because of it's narrower and has fewer sheets.
Yeah. Well, I would call that basic price inflation per unit of the good. I would call that quality deflation. And by the way, they are probably using an inferior quality paper. Not only the bulk weight and the dimensions of a sheet of toilet paper, but they are probably not necessarily. This isn't Pampers. It's something else,
Pampers? What kind of toilet paper are you buying out there, buddy? All right, let's move on from this one. Yeah, and Tom, I agree. I don't think that these companies retooled. That would be a massive undertaking. But I'll tell you what, if I'm Kimberly Clark, and if I can shave off a half an inch on a roll of toilet paper times the billions that I sell per year, my profit margins go up significant. I mean, monstrous gains in my P&L. Just something to keep an eye on.
Well,
and those ones were bad from Home Depot. I actually saw some at Vaughn's that looked like single-serving toilet paper rolls, like literally like 8 sheets per freaking roll. I'm like, what? 99 cents? You kidding me?
Those are for busy protesters.
I mean, back in high school when you go out and go TPing, I couldn't even get it to go up over the tree. They're so short toilet paper. All right, let me keep going here. I want to talk about these charts. There were a bunch that you sent me. The CPI one I found very interesting. The next one I did talk a little bit about on last week's show. And you were supposed to be on, but I just did it anyway by myself. I want to get your take on this one. This is the S&P 500 versus profit margins. For those that are watching online right now or listening to the podcast, I'll walk you through it. It's really going back to 1990. In the white line here, you have the S&P 500. And then on the red line, you have the S&P aggregate profit margin estimate. Okay, so again, it's questionable where we get that data from. But you notice they usually follow lockstep together. As you see the profit margins decline significantly back in 2000, all of a sudden the tech market fell apart. You saw the global financial crisis, but before that, leading it was a sell-off in the profit margin. Not a sell-off, but just a lack of profit margins. And what we've seen in the last couple of months has been one of the sharpest straight down declines we've seen in profit margins on this chart and probably in history. What does this chart tell you, and is it something we should be concerned about?
Well, of course. I mean, I think we need to recognize I philosophically never called it the stock market. I really have always said, and I think it's the proper English, it is a market of stocks. It is not a stock market. Each stock has its own supply and demand characteristics. We generally talk about that as volume. And it has its own liquidity profile. So I've never thought of the stock market. I've always thought that there is a market for stocks. The stocks have traded at extreme premiums, valuation by price to book, price to earnings, etc. We can see in the white on this chart. And we basically saw the dot-com bubble boom where all of us needed to, own a sock puppet or something. But a company is worth a multiple of cash flow. And if the company is healthy and its cash flow has a good prospect for growing, that doesn't guarantee that it will trade at a premium. And we have seen that with the likes of the Amazons of this world. People forget that after the bubble burst in 2000, Amazon was greatly questionable as to go out of business. There was a period of time when Steve Jobs left, before he came back, there was a case where Apple was just going to completely go out of business. It could compete in the PC space, and then it got involved with handsets. So this speaks to me and talks about the future. We know that second quarter is going to have devastating earnings. I have found analysts that I trust, and their estimates run from 37% to 53% declines in profits. United Airlines is burning $30 million a day. Just got another loan from the government. Marriott's. I mean, a lot of these companies are in deep trouble. How many people are going to be? And when Disneyland truly does reopen in Florida, California, and across the world, in its other locations, how many people have an appetite to, go to Disneyland? And what's that going to look like? So, a substantial amount of the profits of Disney comes out of their entertainment centers.
Mm-hmm.
So what this is telling us, in my mind, is I have felt that we're not going to have an orthodox D recovery. I think I said it on the first show that I was with you on Trader Merlin show. I think we're going to have a W recovery. And I still think the prospects, I speculate that it's going to be a W recovery. Now, could that be a crash in profits? Could that be? And again, there are going to be a bunch of companies that are going to go under the retail space.
Yep.
A bunch of restaurants are going to go under. Some of their suppliers are going to have a difficult time, and profits are going to be under pressure. That's got to. But the other side to this is the market wants to go up, but it wants to go up in an environment where there are still multiple headwinds.
Yeah.
I don't think the coronavirus scare is over. We have hot spots right now in places like Phoenix, Austin, Houston's under a lot of trouble, Florida, and others. And, it's surging again in those areas. Some people say that might be part of the exposure from all the protests that we've had. I don't know, but
it can't be good for it, that's for sure.
Certainly hell can't be good for it, So what are the profits going to do? You tell me what the profits are going to do. They're going to be miserable.
Yeah.
They're going to be miserable for the second quarter.
I guess the question, John, is, many people feel that that's already priced in. I for one, agree with you. I'm a little surprised to see it as aggressive as it has moved up. Of course, that's because we've had such tremendous stimulus from the Fed and our government. I still do think we're going to come back and challenge those lows from March. Of course, I've got my money where my mouth is, as the viewers know. I mean, I've got a tremendous amount of put options on the September expiration. But, I do think that the jaw dropper is going to be Q2 earnings. And if we get another pop because of all these protests and we see a spike in coronavirus cases and all of a sudden it turns back into an ugly situation, there's no doubt in my mind we'll end up ripping back down. It's just a question of, where we are on board with that cycle. Again, I've got my put options in place there. I'm still making long trades for the short term, day trading long if I have to and if I see opportunities. But for the intermediate time, not long term, but intermediate, I think we're going to be headed back down towards those lows. So there we go. Ruben says, priced in where? It was priced in that initial sell-off. And now why we're seeing this big rally right now is optimism that everything is okay. So you've got the pendulum has swung from total oh shit panic that everything's going to die to, well, now all of a sudden we've got stimulus on the Fed, we got stimulus from our government, and everyone's returning to normal. That's why you're seeing this huge spike up in our markets. My question is it too soon? We'll find out if those cases of coronavirus really spike up. If they don't and everything goes back to normal, then you'll see S&P at 4,000 in no time.
Well, but yeah, I would agree with that. But, the point is, where are we on the W? We already seen the rise up into the middle of the W, and now we're due for another down leg, possibly.
Yeah.
Let's think about that the stimulus program for the 20 or arguably 30 million people still unemployed. And by the way, it's worse than that. And by the way, if you would pull up on the internet the U6 rate and take a look at the U6 rate, not the U3 rate, that stimulus money for all the people that became unemployed is going to run out in July.
Mm-hmm.
And we're 6 weeks away from the end of July, approximately. And what the hell are they going to do?
Well, they could just easily continue it.
Well, they could, but how many more $trillion of deficit do you want to run this year, Merlin?
John, $1 trillion here, $1 trillion there. Someday it adds up to real money. I mean, we know that they can just keep on doing this. And it's funny, John, you're dovetailed into 3 or 4 different topics that I want to kind of meld into one here. I'm going to show the viewers out at home. This is what John was talking about. Normally, what we are quoted is the U3 rate, which you can see right here. Our May number was 13.3%. The U6, which is what is the true measurement of unemployment, but it doesn't look as rosy, so they don't use it. You're looking at 21.2% unemployment. It was 22.8, so even on that metric, it is declining a little bit, which I think that would make sense because it was just spiking so aggressively. All in all, you want to be looking at that U6. 21% is still very, very, very high. Let me go show you guys another chart here. This is the one I just added to this list. This is from Visual Capitalist, which if you guys have not looked at Visual Capitalist, they put out some of the finest information out there. I love Visual Capitalist. I wish I could get them to sponsor the show. But these are all of the kind of new darling companies or startups or most recent IPOs doing massive layoffs. You can see Uber laying off 6,700 people. That's 25% of its workforce. Airbnb is looking at 25% of its workforce. Groupon, 44. Let's be honest, Groupon just outright sucks. I've been saying to short Groupon since it IPO'd years and years ago. I don't know who Magic Leap is, but you can see a lot of companies in here really doing aggressive layoffs. And, begs the question, John, is this aggressive layoffs most people look at it as a bad thing. It's a sign that there's struggles. You could flip that token and say, well, you know what? This is just an opportunity for them to trim the fat and get things right down to the bare bones minimum and start up again. And it might make the argument that they could be better and more efficient after they do all those layoffs. Which side do you fall into?
Well, I think there's no question those that survive this are going to have to pivot and make the right decisions and I hate to use this term, but it's the proper term, right-size their business model. And, get rid of the fat wherever it's at, trim the sales, and live to compete, in 21 and 22.
Mm-hmm.
The real winners we're going to find out. We'll start to see some real evidence, probably, a year from today? So these markets are a forecasting discounting mechanism looking forward.
Yeah.
And but there's going to be a day of reckoning of what the Fed's done with the balance sheet. We talked about the manipulated marketplace. This has all been. This is the craziest thing. I was born after the Great Depression. Most people thought I was born before, I think, but I was born after the Great Depression. You take the time and read Murray Rothbard's book, The Great Depression. It shows you what the Fed did during that economic holocaust. But that wasn't a true economic holocaust. This was a medical emergency that the government twisted into an economic holocaust by causing all the shutdowns.
Well, John, you were around. You were around during the Spanish flu, so it was the same thing, right?
Well, my dad was. That was my dad you're speaking of.
Sorry, I was just being a smartass.
About my dad with reverence, okay?
Absolutely. I created these graphics, guys, for the show, and I thought this one was just so representative. That is the Fed's hand right there, and Jerome Powell. I guess you could make the argument that's central bankers. This is what I had up for Thursday's session of last week, the Fed's Bizarro Market, which I think is a perfect representation. What's that?
Yeah, I think it is, and this whole market's a manipulation. And I don't think they're going to play the punch bowl. Powell has already said they're going to be accommodating probably well into 2022.
Yeah.
2 or 3 years. He doesn't want zero interest rates, but the market may have something to say about the price of credit, the way things are going. He could go out there and buy, treasury paper that has a small yield right now. But at the end of the day, once that gets into the secondary market, it's the market that ultimately, puts the bid under those credit risks.
Yeah.
But Marvin, let's put this in perspective because I think it's easy to lose perspective. The Fed, after the 2009 crisis, took their balance sheet from $800 billion to where it's at today, and I think it's well north of $7.2 trillion today, isn't it?
Yep.
Isn't that where it's at, the Fed's balance
I believe
sheet?
so. I'll get you the exact number. I'm trying to find a current image of it, but yes, I believe it's somewhere around there.
I think it's about $17.2 trillion. But then we have all these contingent liabilities that are going to have to be taken care of. The government's running humongous deficits. Somebody posted in the chat that the politicians don't care about running deficits. Well, markets will care about running deficits. And, ultimately, if you believe the Austrian School of Economics principles, there's going to be a day of reckoning.
Yeah.
And we can debate what that potentially may look like. But there's going to be a lot of companies that are going to have to adapt. If they don't adapt, they're going to go out of business, and they're not going to get through 21 and 22. And you can look at all the retailers that are, we have over 25,000 retails. National Realtors Association is forecasting that 25,000 retail shops are going to go out of business this year. This year.
And when's the last time you heard realtors say anything negative about the housing market?
Well, sure. Well, with mortgage, look where mortgage rates are.
Yeah, right.
And if you pull up XHB, if you pull up,
real quick, I just pulled up the for the viewers out at home. This is the Fed's balance sheet, and what's crazy is when we saw this spike back in 2009, people were losing their minds, going, we went from under $1 trillion to about 2.5 trillion in just a few months, and that was like, oh my gosh. And you can see the accumulation kept on going till we peaked out around 4.5 trillion. And then in 2015, they started unwinding that balance sheet, following their plan. Props to them. As you can see the slow drift down here. And all of a sudden, we have a little bit of economic trouble. And then you can see the coronavirus hit. We went from, I'm going to call it 4 trillion to 7 trillion in less than 2 months. That is unbelievable flux of capital into the market. It's influx of capital. All right, you wanted XHB.
Pull up XHB.
All right. XHB it is.
He's the home builder.
Yep.
He's the home builders. My daughter is becoming a realtor, and there's not much inventory in North Carolina, in Charlotte, and they're really struggling, If more people are going to be able, because of the enhanced acceptance of the concept of working from home, major Fortune 100 companies are going to adjust what work is defined as. And it's mostly going to be intellectual information age work. You're going to be able to do part of it from home, or maybe most of it from home. You're going to be mobile, and they don't need all this commercial real estate unless they have a business model that demands physical locality.
Yeah.
I mean, look at the education world, universities for both private educators and public educators. Do you want to seat all this, jam 30 people in a classroom when you still want social distancing and everybody wearing a mask? What happens to the social nature of education?
Yeah.
Are you going to deliver more of your content online, on demand and live? Zoom it or whatever, platform you want to use. That's going to radically adjust the revenue that comes to these universities. It's going to be outrageous. Now, if you got a premium brand like Harvard and Yale, it's probably not going to put a dent in demand for seats, because of the prestige of those diplomas. But if you're not, if you've got a kind of a middle of the road Joe Lunch Bucket brand in the education space,
sure,
you're going to struggle. And that's just that's about pivoting and adapting. And those that pivot and adapt and are willing to accept that we're not going back to the new normal.
Yeah.
We're not going. We're going forward to the new normal.
To the new normal,
we're
right?
Not going
yes.
back to the old normal.
Yeah.
Those days are over.
John, I was asked to write an article for a website talking about quarantine and how it impacted me, and I thought, it's actually everything to me relates back to being a trader. It's about adaptation and overcoming any obstacle, and in many cases, when we overcome an obstacle, you come out of it on the other side in a better position because you've learned something along the way, you've refined your practices. And I'm looking at, my personal life coming out of this coronavirus issue, if we are in fact coming out of it, and things have gotten better. I've gone more back to trading. I got the show on my own right now. I'm still actually building content for OTA, and I've managed to juggle all those things, and it's better for me now. And I think a lot of people need to look at it that same way and say, look, it's not going to be the same picture as we went in. I don't know what that picture is going to be, but I'm not going to fear it or freak out about it. We just have to adapt to it and make those changes as necessary and get the most out of whatever situation comes our way. Let me get these... Go ahead.
Wait a minute. To your point, look how many renditions of Online Trading Academy that have taken place. Remember when we started the trading floor? There was no trading floor like that in Southern California.
Yeah.
Remember when we closed the trading floor and had to adapt the model to, what it became with one proactive investor class, that you had a great deal of input that put together that class. Then we adapted the model where we added more content, and we had started adapting the model. We rolled out XLTs when there was a time when we didn't have XLTs. There was a time when we didn't have a multiple class menu for the student to choose from. I mean, all that. And now the company, I don't see Online Trading Academy jamming 30 people in a classroom anymore. You're going to have to distance, assuming what the rules are by the geography. Everybody's going to have to distance.
Sure.
But it's still the same, great education if you apply it with discipline and focus. But at the end of the day, it's got to pivot. It's got to adapt, and it must. It has to.
Yeah. Let me get through these. I got two questions I want to get to, and we're running late here, so I'll try to go through. Mike, I use all kinds of different graphics, but usually the slides there are through PowerPoint. Brendan says, how does the Fed buying corporate bonds affect systemic risk? You got any take on that one? Because the Fed has stepped up significantly and focused on corporate debt, which many believe was the next shoe to drop.
Well, I think we said this on Power Trading Radio back in February. We're probably in a corporate debt bubble. Okay, there's no question in my mind. I don't think we're in a treasury debt bubble because as long as the world is willing to accept our fiat money and are willing to lend to us in the global treasury market, we'll go on. But the corporate bond market, I don't know, Merlin. There are many bonds, individual bonds, that have already crashed that are on sale for the Fed to pick up. By the way, I wonder if they have an appetite for some J.C. Penney bonds. You know what I'm saying? I didn't have much of a problem, except when you look at the capital structure of a corporation, in a liquidation, there are corporate bonds. Some are secured, some are unsecured. Then there's preferred shares and there's common shares. So the biggest risk in the capital market is the stock market, the common equity. That being said, because all the creditors are going to get paid for them, if the company gets liquidated or sold. So here's the bottom line. I didn't have much of a problem. I thought it was kind of novel and perhaps not all bad to buy into bond funds, corporate bond funds, to get diversification, and it kind of spreads that liquidity, over the whole portfolio.
Yeah.
Puts a bid under that ETF or which one you're going to use. I kind of thought that is a better approach than a bunch of. I think they're going to outsource the research on what corporate bonds should I buy. Now, are they going to buy AT&T? Are they going to buy Google bonds? Do they really want some bonds that yield 1%? Well, I don't know. They have Treasury paper that yields 1%.
Yeah.
They want some Amazon bonds. What kind of corporate bonds are they going to buy? Are they going to buy corporate issues that are under stress or distressed credit?
Right. And there's multiple categories. They've actually said they are going to be buying some of that distressed stuff, which to me, you're basically saying, okay, I will support this company, which should probably go under because of their inability to manage debt. And now all of a sudden the Fed's saying, it's okay, we'll backstop you. And it's like, well, wait a minute. We realized from the financial crisis that, if you're too big to fail, the Fed will step in and bail you out and you don't have to worry about anything. Now it's saying, hey, it's not even about just a bank. If you're just a big company and we mismanage our money, we're poor management, whatever, they'll get backed up by the Fed. So, at a certain point, us as individual consumers, as Americans, have to watch our personal finances, make sure we don't go beyond our means because we don't want to declare bankruptcy, whereas these corporations can now look at it and go, no matter what the hell we do, no matter what, we're going to get backstopped by the Fed with our corporate debt, so let's just keep on running ourselves into the ground because they'll save us, they'll catch us.
Well, that's exactly what Japan did, and it's called keeping the zombies alive. And what they've done is that, the governments have their favorites. Remember, the governments get donations from politicians, get donations from various corporations, through various lobbying actions.
Mm-hmm.
And this is just more of the same. Again, is anybody going to buy the JCPenney bonds? Or, do you really, is it prudent to prop up the zombie JCPenney? Or actually, is the most humane thing to do is go ahead and drive a stake through its heart and let somebody else occupy that real estate and take over the inventory and build a new company.
Yeah, I agree. Well, hey, first, John, but first we need to let all the Robinhood traders buy all those companies like JCPenney, like Hertz, and others. And that's the final sign that the company is doomed. I mean, there's reports now that like one of the most popular shares to purchase on Robinhood is Hertz. And Hertz officially released some statements saying, look, we expect shareholders to lose their money on our stock. It's like, okay, I'll buy more.
Not only did they release a statement, they put out an offering statement to sell more stock, and it says in the prospectus, this stock will not make it. Don't even bet that it will make it.
Got to buy me some of that. Where do I get in line for that one? That's great.
I mean, the government doesn't have a real good track record. Remember, if we were to look back on some of the decisions they made on what to back and what not to back, and I remember during some of the solar panel fiascos that I forget the name of the companies now, but the government doesn't have a real good track record of picking winners and losers.
No, they don't.
Excuse me, they have a good track record of picking losers, not of picking winners. So I wouldn't, hang my hat on that. But I don't know, how much different is that than how the government has backed Tesla?
True.
I mean, they're just doing it in a different way. Should there be bailouts? Well, the government, you could argue that government bailed out General Motors. That didn't work out so bad. But my thought was during that era, I thought it would be just fine for General Motors to go through bankruptcy, reorganize. It would probably amalgamate with some other company and continue on. That whole situation could have been handled. And what did the government do there? The government came in and bought preferred shares.
Sure.
The bank bailouts, the government bought preferred shares.
Let them fail. Let's economy do it at free markets. Let them just go. I'm going to do a speed round, John, because I'm running out of time here, but I want to get your take on this one. Gayer, who's one of our friends from across the pond, in a synopsis version, what do you think the chances are that the euro becomes the new reserve currency in the world?
I think it'd be very, very. It'd be very shocking, but it could happen. But I think the conditions of the following that have to prevail is that there have to be, for some cause, a dramatic loss in confidence in the U.S. dollar as the reserve currency. Now, there was a time when the British pound was the reserve currency of the world and was the king of the hill, and nobody thought it was going to get bumped off. And what the real thing that bumped it off was it went off the gold standard, and that allowed everybody to take a pot shot at it. And the dollar became the reserve currency of the world. So you have to ask this. If the dollar does lose its status as a reserve currency of the world, what would replace it? The euro? Europe's not doing so great.
No.
Economically. They're riddled with socialism. They've got their own virus problems. Nobody's out of the woods there. What it could replace the dollar, I've always thought, is a basket of currencies.
Yep.
It used to be called SDRs. Back in the days, they were called special drawing rights. And I think the IMF was kind of behind it. But I would see it prudent let's look at it this way. What if we're going to think out loud? What if we use the Dixie, DXY, the dollar index, and we took the components of the dollar index and we made a basket out of those components? What if it became the reserve currency of the world?
Yeah.
Is that a possibility?
It is. I think it probably, my guess, and I agree with Brendan here, I don't think that Bitcoin has a better shot than the euro becoming the reserve currency, but I do think I can blend both of those together, Brendan's comment and John's comment, and say I could very easily see a stable coin, like, I hate to say it, Libra, being a reserve currency, because it's a blockchain technology. It's super fast to transact. It can go anywhere in the world, and it's a basket of securities, and it'll offer that stability. I don't think there's a chance in hell that the euro becomes a reserve currency. They got way too many problems of their own. If anything, the question becomes, is the euro still around in 10 years? Given some of the instability issues. You've got Brexit happening. You've got Italy and Portugal and other countries saying, you know what, we kind of having issues with the euro, so I don't think that anybody would want to call that the reserve currency given its unstable nature. But I do think a stable coin, which is in the crypto realm, could potentially be that. Of course, the problem there with Bitcoin never being reserve currency is it's not easy to manipulate. Right? You can't print more Bitcoin. And that's the Fed's ultimate weapon. So whatever the reserve currency is, it has to have that capability to make more of it, to bail out markets in different situations. That's just the nature of central banks and fiat currencies.
Yeah. It's just the nature of the beast.
Yep.
Well, you don't want Bitcoin to be fiat. You want Bitcoin to be Bitcoin.
Right.
Okay, and let it do what it does best, which is not be under the control of a central bank who plays all these games of blowing up its balance sheet, just ad nauseum printing. There's somebody said in chat something about, I don't know where it's at now, they said something in your chat about companies not being allowed to go bankrupt.
Yeah.
Many companies are going bankrupt. We'll probably have a record between now, over the next 12 months, I think we'll probably have a record of corporate bankruptcies. Now, some of them will be little mom and pops, LLCs, etc.
I don't think he said that there were no. I didn't say there would be. It was, I think, from Ruben says, why are people allowed to go bankrupt during this time but not companies? Yeah, there are going to be a ton of companies going bankrupt, Ruben. That's for sure. I think there's a likelihood that a company would be saved before an individual. I think that's the difference there. You're seeing the protection of businesses currently going on with these bailout programs by the Fed. But yeah, we're going to see one of the highest spikes of defaults and bankruptcies, I think, in my lifetime coming in the next 6 to 12 months.
Yeah, as a matter of fact, given that we have so much more commerce today and more participants in commerce, we'll probably have more bankruptcies over the next couple of years corporately than the Great Depression. Yep. I mean, I would guess. If you were to add up GDP that will be taken out, it'll get taken out. But people must understand what bankruptcy is. It's not a liquidation. You go into bankruptcy, you have the opportunity to reorganize your company. You have the opportunity to issue stock in bankruptcy if you want, and it is blessed by a federal judge. And bankruptcy is a court of reorganization, and the assets don't go away. We had the bankruptcy in fiber optic. Remember during the dot-com bubble burst, we had those big fiber optic companies that put in too much fiber optic. Well, the fiber optic didn't go away. It got changed in value and price and ownership.
Right.
The creditors ended up owning those assets. The shareholders were wiped out. And, but those fiber optics are still providing service today.
Yep. John, I got to wrap up the show here. I could go on, but I have to pay for a certain amount of storage space for the shows, and if we go over it, I got to pay a lot more money. So,
we don't want to get in that problem.
No, man. Well, until I get corporate sponsorship, it's not going to happen. Are you doing any teaching? Where can our viewers find you? What's you got any social engagements or anything where you're going to be at?
No. As a matter of fact, I don't right now, and. I've got a couple of things I'm working on in the mill. Nothing that I'm want to announce or address, but I'm working on some ideas.
Okay.
And when it's time, you'll be the first to know.
Looking forward to it. And if you ever want to do something, I've always got the channel. You're welcome to come on anytime.
Good. I appreciate the opportunity, and I just want to say, peace. Be safe.
Thanks, John. Have a fantastic evening. Great having you on. We'll get you back on here in a few weeks.
Thanks.
All right, take care, John. Guys, that was John O'Donnell. The Ambassador of Opportunity is what I've called him for many, many years. Hope you enjoyed that one. We could go on and on about charts and macroeconomics. There's so many little nuances about this market that we could argue are going to push it to all-time highs or send it vaulting even lower to, not all-time lows, but significant lows. I don't know which way these markets are going to go, and a lot of the content from today, obviously reflected that, but there are some metrics out there which do point to negativity. I actually did a chart of the week on Saturday, which some of you may have seen, which talked about income versus spending. And that was actually one of those pieces that is very positive for our markets. I don't want to always be saying negative things about the market because there's good stuff out there and bad. It's just which force is going to rule and push harder for these markets. Right now, it definitely seems like the bulls are out there pushing this market higher at any opportunity. We had two or three down days, big deal over the last couple of months. A couple of months, but about a month and a half. So we'll see where it goes from here. I can't tell you anything other than what is happening tomorrow. That's all I can really tell you. The 16th does bring us some interesting pieces of information. Today we had the Empire State Manufacturing Index, which I didn't get a chance to show you guys. I'm going to show you that one here real quick just because it's pretty critical in understanding why this market did what it did today. Here is today's Empire State Manufacturing Index, and look at the top line there. We were looking at significantly bad numbers, like really, 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 really bad numbers. Went from negative 48, the expectation was negative 30. We came in at negative 0.2. That means we're almost back to an expansion mode in the Empire State Manufacturing Index. So that is a tremendous swing, I think very, very beneficial for the overall markets. I'm sure that is one of the main reasons why this market did what it did today. Here's what's cooking for tomorrow. Tomorrow you have the German ZEW Economic Sentiment Report, and really a big day for the U.S. I'm very curious about these numbers in the middle of your screen here. Those are the numbers pertaining to retail sales. You can see that the previous retail sales number was negative 16.4. They're expecting it to be a positive 7.4%. That's a pretty interesting turnaround as well. So we'll keep an eye on that one. I'll tell you what, if it comes out anything higher than 7.4, this market's going to rip to the upside very, very quickly. You also have Powell testifying. That's going to be at 7 a.m. So 30 minutes into the market open, you will have Powell testifying. So be very careful. It is one of those ones is going to be a major market mover. Also at business inventory, so it's a heavily stacked U.S. market tomorrow. Could be a very volatile one. Earnings-wise, there hasn't been too much in the earnings front, but we talked about home builders today. You can see here we have Lennar reporting earnings tomorrow, which I think will be interesting, and Oracle Corporation, which is one of the majors, one of the big guys. They will also be reporting earnings. I believe that those are going to be BMO before market. Actually, I think Lennar is before market opens. Oracle will be after market close. Brian wants to know my update on my put position. Nothing's changed. I mean, today was obviously a big swing, but I'm still holding it until July. It's third week of July. Right now, it's underwater by a good margin. What else we got there? Cool. I think that does it for today, guys. I went really long, and just because Big Eb is in here, I'm gonna try to wrap this show up with just seconds under a 1 hour show, and I think I might actually do that today. So thank you guys so much for joining us. If you enjoyed that with John, do me a favor, click that little thumbs up button. Of course, if you have comments or questions, send them in the video underneath the YouTube videos out there. That's probably the best way to get in touch with me, or you can go to tradermerlin.com. You can send in your questions at that point as well. That will do it for today's show. Everybody have a fantastic evening, and I will see you tomorrow for maybe another 59-minute show.